Thanks very much and welcome everybody. Basically, an awful lot of what's going on is about inflation. There's an awful lot of the central bank activity in the middle of that. And so we need to discuss about exactly what that means. And central banks are changing the dynamics of what we're seeing in so many asset classes that it is time to really sort of spend some time on this. So they're key to financial market sentiment and trends. Why? Well, their monetary policies literally dictate what we see in asset classes. So we had the big risk on moves when they were suppressing rates and with QE and driving people to sort of invest in high risk assets like equities. So they made themselves feel more wealthy. Well, you know, we saw, if we look at this chart on the right, that they did that very well indeed. And they indeed got stocks up to some incredible levels over, even if we look from March 2009, that is quite a run with just a couple of blips in it. Buy the dip was the common theme for everybody, and everybody made a lot of money. The problem is we have inflation now. And with that, the Fed has decided that this wealth effect that they created needs to be reversed. And that is exactly what they are trying to do. And so that changes the dynamics of this buy the dip mentality and ongoing surging stocks on the basis of what we call TINA, which is there is no alternative. Well, you know, maybe there is, because there is now an awful lot more risk involved in buying equities than there was. So QE helped keep interest down. It's called suppressing rates. That's what it's designed for. And basically, the need for that has disappeared. But as they do that, they were expanding the balance sheet. So their balance sheet is stuffed full of US Treasury bonds and mortgage-backed securities. Now, when they start jettisoning those from their balance sheet, the opposite impact comes onto markets. And so therefore, the basic crutches that have held up these markets for so long are removed. So how can that not make a difference? And we're seeing that now rather belatedly in equity markets. But look at inflation. Inflation is absolutely screaming higher everywhere. And in the US, yet again, we've seen basically you know, even today when inflation was expected to drop, it came in higher than expected yet again. So low interest rates are fine in a deflationary world, but realistically in an inflationary world, they need adjusting, and adjusting quickly. Now, on the back of this, there's talk of, can the Fed create a soft landing for the US economy, which means no recession? Unlikely, because the last time and only time they've done that, back in 1994, they were preemptive with inflation and were ahead of the curve, whereas now they are playing catch up to inflation and are behind the curve. Very different dynamic. And I think markets are beginning to understand that. So if we look at central bank moves to date, we've seen the RBNZ very early to start moving rates. Very clever central bank there. They saw the problems quite early. And we've seen moves to 1.5% now, 50 basis points on 13th of April. The same day, we saw 50 basis points from the Bank of Canada. We've seen just 25 basis points from the UK in the last meeting, moving them to 1% as well. Now, the Fed has moved 50 basis points, but has also suggested, like the Bank of Canada, that there's possibly 2 more 50 basis point rises coming. So this has increased volatility. And the point is, we've got different strategies from different central banks, which means we get yield differentials moving around in foreign exchange markets. So there's opportunity here. And one of the biggest trades we've seen from that, obviously, is zero rate policies in Japan upheld, whereas rate rises in the US. So therefore, dollar yen has gone up. So things like that, you know, we've seen stock markets turn far more risk averse, and bond markets have seen a steep sell-off with higher yields and also a lot of volatility. Now, the only thing I would say about volatility is it can create a nasty feedback loop where you get higher volatility, which creates less liquidity, which creates higher volatility. So dangerous markets is what we're trying to get here. So these changes in policy, there's a real danger to stock markets that central banks start considering the reduction of their balance sheets. Now, as I say, this is one of the crutches that took stocks higher. So reducing that, in fact, turning one of the largest net buyers of bonds to one of the largest sellers of bonds has a massive impact for yields. And so we've seen this steep rise higher in yields as the balance sheet is started to be reduced. But they are just at the beginning of this. They have not even started really attacking the size of the balance sheet. They're still supportive of financial conditions, which they are trying to tighten, which means they want asset markets lower to make us all feel a little less wealthy. They're doing a very good job at the moment from where I'm sitting. So there's this reduction of the balance sheet is called quantitative tightening. It's the opposite of quantitative easing, and it is basically the exact opposite. So last week, the Fed gave forward guidance on this, and they said they're going to be sort of looking at different ways of allowing some instruments to roll off, but they are talking about potentially actively selling instruments from the balance sheet. So when it begins its multi-trillion-dollar balance sheet wind down in June, there could be a further impact from the reality of that on risk assets and equities. So if we look at the US Tech 100 on this chart on the left here, you can see the damage that rising rates or raising rates has done. Rising yields impacting very heavily on the tech sector. So, I do think that whilst the effect has been relatively immediate, I'm not sure if it's all there yet because we still haven't seen the active selling of these instruments from the balance sheet. So risks remain. Volatility is remaining quite high, which makes trading very difficult. So look at these wild swings we're seeing. Stock volatility may have further to rise. We had the VIX up at 35 yesterday. It's sticking up there. That probably means daily ranges of 3.5%, 4%. And we're seeing this. Now we've got the VIX, we've got the European stock market gauges of risk as well, and the Bank of America Move Index, which is the volatility in bond markets, all screaming higher. This is a massive canary in the coal mine for risk. You need to be careful that markets are going to trade erratically and could surprise you. And so therefore we need to trade accordingly. Now, the central bank's wish list at the moment is to tighten monetary conditions or financial conditions, if you like. And that means they want to hit the demand side of the inflation dynamic. There is very little they can do with the supply side issues. And so the only place they can go is hitting demand. So, they want to avoid a stock market panic, but what they would like to do is to see a risk move down, which actually makes maybe the consumer feel less confident, less wealthy, spends less, and gradually the economy can come down. Organizing or manufacturing a soft landing in the US economy looks, I think it would be close to a miracle if they managed to pull this off, because they're a long way behind. So they're looking to cool down the economies, but the trouble is they could force them into a major stall. And that, whilst is a threat to global growth and the economy in the US, it does actually throw up opportunities. So the global shift away from easy money is poised to accelerate later this year. And therefore we need to adjust what we do with our trading strategies as well. So this idea of a Fed put, this base that everybody thought was going to be in, if stocks fell more than 10%, the Fed would change policy and support stocks. That's not there, because the point here is they actually want stocks down. They want you to feel some pain, because this is a demand-driven inflation story, and therefore they need to sort of see this pain in the markets, almost hiking into a recession to get the inflation genie back in the bottle. And then they can start addressing the growth problem. The danger here is that stock markets will need to stand on their own 2 feet, but they're very used to having this support blanket from the Fed for 12, 14 years. And QE dragged stocks higher over 14 years. It's gone. It's over. It's done. Now, I'm not saying we're going to see a crash here, but the point is there's a readjustment in the markets because there's a readjustment in sentiment. And that is exactly what the Fed tried to create in their policy that they're using right now. So are QT interest rates rising, going to fuel a choppy downtrend for a while? Absolutely, yes. High volatility, we've moved to a sell the rally or sell the rip, as we call it. But don't forget, it's worth buying those dips as well, because when we have very high volatility, we're not going to have a one-way move here. It's going to be very choppy indeed. And that's exactly what volatility brings us. So can excessive dips be bought? Yeah, possibly if you're a long-term trader, but you need to do it in the size you can afford to see some reasonable losses against you, because at the moment it feels like a falling knife. But within this, rather than trading the indices like the USA 500 or the Tech 100, I think now we've moved to specific stock picking within specific sectors. And there is some value there, but it may be a buy and hold trade. Trading the indices at the moment does not tell the whole story. So I think we need to be more specific rather than just trading the DAX or German 40, USA 500 or the Tech 100. Higher interest rates do matter, and they are actually impacting stocks. So, are there key acceleration levels that market professionals are watching for the downside? This break of 4,000 on the S&P, this chart on the S&P 500 shows you this. We're broken down below 4,000 again. 3720 next level. Could we see something like that? Possibly on a correction basis. It looks like it's pretty close to a 38% retracement. That would be something fairly normal in a longer term macro retracement in a long-term uptrend. So maybe that becomes the support level, but we need to play this on a fear issue as well. At the moment, fear is dominating greed. Greed has been there for 10 or 15 years. So central banks are not all moving in lockstep either. We've had the Bank of Japan sticking to very deflationary policies. We've seen the ECB slow to react, and the Ukraine situation damaging growth prospects in Europe, making them more cautious. We heard an also rather cautious Bank of England talking about growth over inflation. They've got to be careful how they deal with this. And I think if we look at this like Euro Aussie at the moment, we saw Euro Aussie rise as commodities got absolutely hit. But the RBA is talking about raising rates and possibly start of a rate hiking cycle. And there is talk that COVID cases in China are moving down very quickly. Could we see unlocking there that then drives the demand for commodities? And therefore the Aussie does quite well on the back of that. It's an interesting time, but timing some of these trades with volatility where it is extraordinarily difficult. So we need to deleverage, be sensible, do our research, and take care. Trade according to the markets in front of you, and they are volatile, and there is a lack of liquidity in that. So it's caution is the message you're getting from me here, and it's about being specific about what choices you make on trades.